There have been a couple videos about the recent massive percentage price increases in Medicare supplement plans, but those videos lack some very important information on why these unusually high price increases are happening, and that as a result they point to potential solutions that really won't do any good. Well, they won't do you, the consumer, any good anyway. We've seen Medicare supplement plans with 20%, 30%, 40%. I saw some that were at 65% price increases. What's going on? Since Medicare supplement plans were modernized in 2010, the past couple of years have been the worst string of Medicare supplement price increases ever. In this video, I'll detail why this is happening and what you can do to shield yourself to some degree from future rate increases. I'll also provide some real-life solutions to the industry problems that created this situation, things that you can do to protect your ability to afford a Medicare supplement plan in the years ahead. First, the rate increases are not simply due to an increase in people having expensive medical procedures. That is happening, but it most certainly is not why you are experiencing the price increases like what we've seen here recently. Second, as you will see when I walk you through the real cause of these price increases, it's very possible that the Medicare Supplement Plan N with some insurance companies is set up for even higher price increases than the Plan G within the next few years. This is a very important video. If you currently have or are contemplating getting a Medicare supplement, missing out on what I have to say can be costly. So let's get into it. When we first started seeing massive price increases just a few months ago, I could tell something different was happening or had happened in the industry. Something was wrong. I needed to know why annual price increases went from us considering a 10% rate increase as an extreme outlier just 6 years ago to being considered a low rate increase for 2025. But getting a reasonable explanation was nearly impossible. The first line I was told from virtually every insurance company was that insurance claims were post-COVID had increased and that companies are just trying to price in all the increased demand for healthcare services that were delayed due to COVID. And that seemed to make sense at first, but as the numbers came out, it didn't add up, not even close, and I'll show you that in a second. So I scoured a few actuarial publications. I spoke with some industry insiders. I know some number crunchers, and I found out the problem's a lot worse than any of us were prepared for. And the first hint came with this piece of information from GenRE. GenRE releases an annual report on Medicare supplements, and this was the latest one, and previous releases of this annual report did not include profit margins. But here it is front and center in the report published for 2024. Why? Because it's a new problem. So this shows that for 2023, the typical new block of Medicare supplement business is losing 5.9% annually, with a range between a loss of 31.3% to a loss of 4.7%. Now, I'm not going to get overly geeky here. In fact, it took me a long time to come up with the simplified explanation that I'm going to show you. But I need you to understand two things here. First is the difference between an open block of Medicare supplement business and a closed block of Medicare supplement business. An open block is simply a block of business that's still accepting new business. When you purchase a Medicare supplement plan, you're buying into an open block of business. A closed block of business is a block of Medicare supplement plans that are still being serviced, but you can't buy into it. Now that's kind of like a Plan F. You may not be able to buy a Plan F if you are new to Medicare as of 2020 or sooner, but there are still people who have this Plan F, and those plans are being serviced by the insurance company. But all the Plan F policies are closed or a closed block to people who are new to Medicare. Now, that's not a perfect analogy, and I'll explain in more detail here later. So note here on this page where it shows the claims trends. Now for 2023, it shows claims trends were 8.6% of open block policies and 12.4% of closed block policies. In 2019, it was 6.2% of open block and 6.7% of closed block policies. So yes, claims have increased, but a 2.4 percentage point increase in open block claims over 4 years is not enough to justify the back-to-back 25% over 40% annual price increases. Increased claims are not the primary driver of the price increases that you've seen lately. The real culprit is a major systemic error in Medicare supplement pricing models. That's much worse. So what happened and what is happening? As the baby boomers turning 65 market has accelerated over the past few years, an increasing number of insurance companies decided to try their hands at Medicare Advantage and Medicare supplement policies. I discussed this in a previous video on hidden risks within Medicare supplement pricing. There have been a lot of insurance companies starting new Medicare supplement plans. Most of these companies, like many of the property and casualty insurance companies most recently, have no experience with pricing Medicare supplement policies. But here, they're trying to get into the Medicare supplement health care business. They need to get a foothold into an existing and thriving market. Because Medicare supplement policy benefits are standardized, the only thing these new companies had to compete with was price. The biggest Medicare market is the age 65 to 68 window, where most people enroll in Medicare for the first time. So watch this example. I'm using some random numbers just to illustrate a concept. So this is illustrate a concept, not actual policy premium rates. Let's say an insurance company looks at the market and finds that they want to launch a new Medicare supplement plan. Considering the average health profile of, let's say, 90% healthy people with low expenses and 10% people that are actively seeking doctors for health issues, they figure they need to charge $150 a month for this new supplement to break even. Now, if they charge less than $150 a month, they lose money. If they charge more than $150 a month, they make a profit. But there are already competing policies active in the marketplace from other insurance companies with prices lower than $150. In order to compete and establish a market share, they decide they're going to have to price this policy at $125 a month, taking a loss just to build their business. They want to build market share. That's normal. The idea is that somewhere 4 to 6 years down the road, they'll increase the price to $150 to break even, and then moving forward, increase again and start making a profit. Now, imagine 10 or 15 different insurance companies doing this in the same market all at the same time, each trying to outbid each other. The result is not who can operate on the lowest profit margin, it's who can withstand the greatest loss. Now, a few years go by and the insurance company increases their rate to $150, thinking, great, we'll be breaking even, finally. But this is where they make a fatal miscalculation. Medicare supplement policyholders are not as sticky as expected. It's an economic term. When a company increases the premium by more than just a few percentage points, people simply switch insurance companies to lower their premiums. But not everyone switches plans, just the healthy people. The insurance industry has a term for this. It's called anti-selective lapsation. You don't need to memorize that. Just understand that if there is a term for it, the insurance industry is very aware of what's going on here. To change insurance companies in most states, you must qualify medically. People with a health history of critical or chronic disease cannot make a change. The result is that the health profile of this pool of business just decreased from 90% healthy to, say, only 70% healthy policyholders. This means more medical expenses per dollar of premium collected. The ratio of medical expenses per dollar of premium collected is referred to as a loss ratio. The loss ratio is the percentage of insurance premiums that are lost to medical bills due immediately. A lower loss ratio leads to price stability. Now, instead of the insurance company needing $150 to break even, they need $175 a month to break even. Even though they just increased their premiums, they're still operating at a loss. Are you with me so far? Please let me know in the comments if this is or is not making sense. It's very important. So what's the next step? Well, the insurance company wants to improve the health profile of this pool of business and bring in new policyholders, but only healthy policyholders. They want only healthy new policyholders so that they can lower the loss ratio and stabilize the premiums that you are paying every month. To do this, they encourage agents to solicit medically underwritten business. They pay agents a little extra to market to existing Medicare supplement policyholders that will need to qualify medically to switch companies. This saves the consumer money because their competitors have higher prices while increasing the quality and the health profile of this pool of business, leading to better price stability. I know that sounds like a lot, so I hope you're following with me on this. It's a great strategy, and it would work except for two problems. First is that all the insurance companies are doing this, so you still end up with policyholders playing musical chairs running after the cheapest plans. And just as one insurance company is trying to steal the healthy clients from a competitor, other competitors are trying to steal their healthy clients. Second is the nightmare scenario from which there is no recovery. States creating laws that require the insurance company to accept all Medicare supplement applications regardless of the applicant's health. Once this state law is implemented, the insurance company is handicapped. They're not able to go after underwritten business to improve their pool and keep prices lower. What I'm referring to here are the birthday rules. A birthday rule is a state law that overrides Medicare and provides consumers with an annual window of time where they can change insurance companies regardless of health. It provides an annual guaranteed issue period for everyone to apply for a Medicare supplement. Now, a couple of years ago, there were just 9 states that offered birthday rules in a birthday rule window. Now there's 17 states plus another 7 states with active legislation being discussed. Now I'll provide a list of those states in the show notes. And the subject of birthday rules deserves its own video because there is more to discuss than what I can fit into this video. Politicians like birthday rules because it makes them look like or feel like heroes. 20% of Medicare supplement applications are denied because of a person's health history. And politicians believe that making a law requiring the insurance company to accept this, all of these people, is a win. The truth is, the biggest impact a birthday rule has on a Medicare supplement is higher prices for everyone. 100% of the people in their state that have or want a Medicare supplement plan will pay significantly higher prices after a birthday rule becomes law. It typically takes 2 or 3 years after the implementation of a new birthday rule law to see its full impact on price. Now, more on that in an upcoming video. So please subscribe and check the bell icon to be among the first to see that video. And I'll also include in that video as a solution that is close to a win-win for both the consumer and the politicians. So back to our example. So the insurance company that was hoping to break even at $150 monthly premium is operating at a loss. As a result, they raised their prices again, and this time to $175 a month. And again, a good percentage of the healthy people jumped ship, and even at $175 a month, the insurance company is still losing money because the healthy people are leaving. They started at $125, but are still losing money at $175. At this point, the Medicare supplement policy we've been talking about is no longer price competitive. People new to Medicare in that area are buying policies from their competitors, not from this pool, because it's too expensive. Competitors have their own new pools of business operating at a loss to attract market share, and that's where the new buyers are going. So the insurance company closes down this overpriced pool of $175. They service the policy, but no one new can buy this specific pool. No one's buying it anyway because it's too expensive. So overnight, this overpriced supplement becomes a closed pool. To remain competitive for new business, the insurance company then opens up a new pool at a low competitive price, operating at a loss, and starts the process all over again. This is referred to as a charter rotation strategy in the industry. And yes, if nothing changes, the results will be the same as well. Again, imagine 10 or 15, in some areas 40 different companies all doing this in the same market, trying to outprice each other, seeing who can handle the loss. And this is why we've seen such enormous price increases lately. Too many new players entering the Medicare supplement market, willing to take losses to gain market share. Then everyone, even established companies, decide to compete on price as well. Because remember, the benefits are standardized. And this is leading everyone operating at unsustainable losses. Of course, when prices increase, healthy people jump ship, leading to a worsening health profile of policyholders. I mentioned earlier that this impacts all Medigap plans. It doesn't matter if it's a Plan G or a Plan N or a high deductible plan. If the plan was originally priced at too high a loss, it can't overcome that with higher prices because of that anti-selective lapsation. But as I showed earlier with the Gen RE data, pricing new policies at a loss to gain market share is now the new norm. But Medigap Plan N is not immune to this. In the past year or two, I've seen more price competition for Plan N across the country. Insurance companies are actively trying to gain market share for their Plan N business. And if they're using the same deep discount model for Plan N that we've seen for Plan G, and I believe they are, you can expect for many insurance companies that price increases on Plan N over the next few years to be potentially higher than Plan G. So what is the solution? The first natural solution is that a lot of new players to the Medicare supplement market will simply go out of business. Some already have. In a series of videos I titled Hidden Risks in the Medicare Supplement Market, I state a rule I have to never recommend an insurance company that has not been in the Medicare supplement market for at least 5 years. The pricing issue that I just discussed is the reason why. Now, this used to be a problem specifically with companies that were new to Medicare. Unfortunately, there have been so many new companies competing in the market, the Medicare supplement market, that even established companies have had to adopt this charter rotation model to the extreme that it has taken, and their plans are priced at too low of a starting point. The high loss ratios required to be competitive with a new Medicare supplement were simply too great to overcome. The second solution is partly under your control. The lowest premium plans, specifically in the age 65 to 68 market, are going to be the plans most likely to experience very high price increases later on. We need to consider that gimmicky price discounts and high percentage discounts are not free money. You may be paying those discounts back many-fold down the line, as the insurance company must recoup that discount to make any profit in the years ahead. In addition, insurance companies need to understand that many of their customers, their policyholders, value price stability over lowest price. Insurance companies are doing themselves and their customers a disservice by racing to the bottom with the low price strategies. A strategy that focuses on price stability rather than cheapness will gather a strong, loyal following among both policyholders and agents. The lower turnover of clients that would result will create more predictability in profits, more predictability in premiums, and be a win-win for everyone involved. I purchased my first Medicare supplement plan as I recently turned 65. The insurance company I chose was not the lowest price in any market or in any state. And I chose it for price stability because it found a way to compete on a value-added basis, not price. And I'll talk about that in detail in a video coming shortly. And you should subscribe if you want to see that video. Lastly, politicians need to get out of the insurance business. If I were to list out the 15 states with the most expensive Medicare supplement policies in the country, they would all have one thing in common. They are all states where the state legislator was created pricing regulations that they believed would help the least fortunate. Instead of helping, they simply created a regulatory platform where the insurance companies had no choice but to raise premiums for everyone. In many cases, this has forced people out of their Medicare supplement plans and into Medicare Advantage plans. There's no free lunch. There is no way to make a Medicare supplement policy available to everyone all the time without making them too costly for most people to ever afford. In which case the supplements are legally available but priced out of reach for the average person. Consumers are harmed by the massive price increases in Medicare supplement policies. These prices have and will continue to push many out of the Medicare supplement market and into the very profitable and heavily subsidized Medicare Advantage arena. And I know this has been a long video, but it's only half the length of the original script that I wrote for this because there's so much more to every aspect of this subject. So I'm going to close this video with a very sobering message to the Medicare supplement insurance companies, and one can only hope they listen. I don't know if you assume that the Medicare supplement industry can survive your pricing model mistakes, or if the intent is to make Medicare supplement insurance policies for the rich only, pushing most people into Medicare Advantage plans. But one only need to look at the last time insurance company pricing models were this far in error to see that both the consumer and you, the insurance company, will suffer your mistakes. I am, of course, referring to the long-term care insurance fiasco of the late 1990s and early 2000s, where insurance company pricing models grossly underestimated lapse rates, claims, and mortality, in addition to falling into the same race to the bottom with competing on premiums. There too, the result was massive price increases, very similar to what we're seeing today, which resulted in a lot of policy cancellations. The consumers were harmed by being priced out of that market. Now, only one major insurance company collapsed from that mess. That's due to the protections that are out there. That was Penn Treaty. But a host of companies never recovered financially and are still bearing the losses. General Electric, GE Capital, went from being one of the most financially powerful and respected companies in the world to becoming Genworth. Genworth, if you're not familiar, is like a low-rated former A-lister actor whose last great performance was long ago, and the current generation doesn't even know who they are. Then there was Conseco, now C&O Financial, who was pushed into Chapter 11 over long-term care. And there are plenty of others. People running the Medicare insurance companies should know exactly what I'm referring to. The current situation reminds me a lot of what happened to long-term care insurance. Health insurance is about providing a service, providing a value for the premium. Your market is the retired, the group of people who most need price stability and predictability, not cheapness. I strongly urge you to rethink your approach to Medicare supplements. Price your policies for the long-term stability, then educate your agents and your staff on why price stability is a winning pricing model for the long run. Stop racing to the bottom. It's a race where we all lose. I'm Matthew Clausen with Medigap Seminars. Thank you for watching.